the opposition in Cyprus, so we'll see how it goes tonight. Melissa.
All right, Amy Kellogg, thank you so much. For more reaction, let's bring in Dan Mitchell from Cato. We also have Alan Nuckman of Bullseye Options at the CME. Dan, let me start with you. So Amy just told us that we were thinking a while ago that this vote was not going to get done by midnight. We have 25 minutes now to go. She's saying the latest intelligence is that it will. What do you think the outcome will be? And if it's no, what does that mean? What happens next? Dan.
I think the answer will be yes, because if they vote no, it means they don't get more bailouts. And all these looters and moochers who are rioting in the streets of Athens, if there's no more bailout, there's even more austerity. And so what you're really seeing is a temper tantrum of the Greek people who just don't realize that you can't consume what you don't produce.
Alan, do you agree with that?
Well, I'm not going to get into the politics. I'm a price action guy, and the markets really have not been impacted by this at all today. You can see the stock market took a little breather, but we're still very close to unchanged, even with all this drama that we're seeing. And the futures are moving up. The futures are up. We've got good earnings out of Intel and Netflix, and that's what's driving the markets. The fundamentals here are driven by the earnings. That's more important. But if there is some major surprise, which the market hasn't priced in, we'll see some actions in the futures overnight. But look at that euro currency still hanging around the 110 level, which is significantly off of those lows from March and April.
Why is that? Why aren't traders more focused on this then?
It's just we've been down this road before. We've seen this movie, and we know how it ends. It's not going to drag down, America. And if nothing else, it makes corporations, U.S. stocks, more attractive as far as stability and yield and profits and earnings.
Dan, do you agree with that?
I agree. Greece is only 2% of Europe's GDP. And, of course, that's just a blip compared to the United States. And so, frankly, a lot of that debt, if it was all held still by big banks, yes, it might be destabilizing, but all this debt has been unloaded by the banks onto European taxpayers. So if I was a German taxpayer or an English taxpayer, I'd be all upset, but this isn't going to affect the markets. What will affect the markets is when the next dominoes begin to fall: Spain, Portugal, France, Belgium, and by the way, keep your eye on Japan at some point in the next few years.
And if I was a German taxpayer, I would be furious, because there's no way you're ever going to get your money back. I mean, the only way out of this is more austerity, economic growth. That's not happening, because you're looking at, an aging population and shrinking growth. Or forgiving the debt. That's the only other possibility, lowering interest rates. Anyway, gentlemen, I think we're going to leave it there for the moment. Is that right? In the meantime, Netflix